Somewhere right now, there's a 24-year-old sitting in a performance review being told he needs to show more initiative by a manager who has worked at the same company for 11 years and drives a leased car. He nods, he smiles. He goes back to his desk, opens LinkedIn, and starts a new job search. His manager has no idea. That's not a story I made up. That's just Tuesday. Meanwhile, the same week, a different 24-year-old just crossed $40,000 a month running 3 income streams she built from her apartment. No review, no manager, no one deciding what her time is worth. Here's what the first guy was told his whole life. Stay loyal, put in the work, climb the ladder, and the system will reward you. And here's what Gen Z actually sees when they look at that deal. A company that will lay you off over Slack, offer you a 401k instead of a pension, post fake job listings to keep you anxious, and then fire you at any moment for a business reason that has nothing to do with your performance. So, the question isn't why does Gen Z refuse to give their best years to a company? The real question is why did it take this long for people to notice the contract was already broken? We're going to explain exactly how this system works, why it was designed the way it was, and why refusing to play by the old rules is the most structurally rational financial move a young person can make in 2026, and why it's getting weird. Let me give you the central image I want you to hold in your head for this entire video because it explains everything. Think of the traditional career path as a conveyor belt. You step on at 22, fresh out of school. The belt moves at a fixed speed. You don't control the speed. You don't control the direction. You can work hard on the belt. You can run in place. You can even impress people around you, but the belt still moves at the same speed. If you follow the rules, stay loyal, don't make waves, wait your turn, you arrive somewhere at the other end around 65, hopefully with enough saved to stop working. The conveyor belt was designed in an era where if you stayed on long enough, the company handed you a pension at the end, a guaranteed monthly payment for life. That was the deal. Your time, their direction, their guaranteed reward. Here's the thing, the companies quietly removed the reward. They kept the belt. That's the entire thesis of this video. Everything else is just the details. So, let me walk you through the 4 levels of this. Each one gets a little darker. Each one makes more sense of what you're watching Gen Z actually do right now. Level 1, the original deal is dead and companies killed it first. Here's something that almost never gets mentioned when older executives complain about Gen Z's lack of loyalty. In 1980, 38% of private sector workers in the United States were enrolled in defined benefit pension plans. A defined benefit plan is exactly what it sounds like. You work for a company, you stay loyal, and when you retire, the company pays you a guaranteed monthly income for the rest of your life. That is the reciprocal loyalty contract. You give me decades, I give you security forever. By 2008, that number had fallen from 38% to 20%. By 2022, it's down to 15%. Right now, only about 15% of private industry workers in America have access to a traditional pension. The rest got a 401k, which is a retirement vehicle where the company might match some of what you put in. The rest goes into the stock market, and when you retire, if the market did well, great. If it didn't, that's your problem. Think about what actually happened there. At some point in the 1980s and 90s, corporations made a structural decision to convert from a system where they bore the retirement risk to a system where you bore it. They didn't announce this at a press conference. They just changed the plan. Until 1984, defined benefit plans actually had more participants than defined contribution plans. Then it flipped, slowly then all at once. Now, I want you to think about timing for a second. The oldest Gen Z workers were born in 1997. They grew up in households that already had 401ks, not pensions. They entered a workforce that was already running the new version of the deal. They never got the original offer. And the people who are now complaining about their lack of loyalty are in many cases the same generation of executives who quietly cancelled it. Look, I'm not making a moral argument here. Corporations are not people. They're incentive structures. When it became financially advantageous to shift retirement risk to employees, they did it. That's just how the system works. But when we sit in boardrooms today and act surprised that young workers don't feel a deep personal loyalty to a company, we're ignoring the fact that the company already told workers exactly how it values them. It told them through the actuarial models it used to replace pensions. The belt doesn't care about you. It just keeps moving. And if you understand that, then the behaviors that look like Gen Z disloyalty start looking like something else. They start looking like a rational response to an accurate reading of the incentive structure. Here's what I mean. If a company removes the long-term reward from the loyalty equation, then long-term loyalty becomes irrational. It's not an emotional reaction. It's a math problem. And Gen Z, whether consciously or not, is solving the math problem correctly. I want to give you a quick scenario. Call it the two brothers problem. Not a real story, just a parable to make the math visible. Imagine two 22-year-olds who graduated the same time with the same degree, same GPA, same starting salary of $60,000. One of them, let's call him Marcus, gets a job at a mid-size company and decides to be the loyal one. He works hard. He shows initiative. He turns down other offers. He believes in the mission. After 3 years, he gets a promotion and a raise to $72,000. His manager loves him. He's on the fast track. The other one, let's call him James, treats his job like a stepping stone from day one. He spends 1 year learning the role, builds his resume, applies elsewhere, gets an offer for $80,000, and takes it. A year and a half later, he does it again, $85,000, then $94,000 at year 4. By year 3, Marcus is at $72,000. James is already past 80, and that gap compounds. If you earn $10,000 more per year and you invest that difference at even a modest return of 8% annually, after 10 years, you're not just looking at $100,000 more in total pay. You're looking at a meaningful difference in invested assets, in compounding returns, in net worth. The math on switching used to be undeniable. Now, here's where it gets interesting. That math is starting to break down, too. And that's level 2. Once level 2, job hopping stopped working as a salary hack, and almost no one is talking about why. For about a decade, from roughly 2012 to 2022, the strategy of switching jobs every 1 to 2 years was one of the most reliable ways to accelerate your income. The gap between salary increases for job switches and salary increases for people who stayed put was significant. As recently as 2 years ago, job hoppers were seeing wage increases roughly 7.7%, while stayers were getting around 5.5%. That's a meaningful spread across a career. Then something changed. By early 2025, that gap had nearly collapsed. People who stayed at their jobs received about a 4.6% raise. People who switched got about 4.8%. That's a 0.2% difference. Statistically speaking, that's almost nothing. And for the first time in roughly 10 years, the financial case for pure job hopping has basically evaporated. Now, this is important because a lot of commentators looked at this data and said, see, Gen Z needs to stop job hopping and start being loyal. But that's the wrong read. The wrong read. Here's why. Gen Z's average job tenure in the first 5 years of their career is around 1.1 years. That's not because they didn't do the math. It's because the math changed. The strategy of job hopping for salary gains is going away, yes. But that doesn't mean the answer is to go back to the conveyor belt. It means something else is happening. The conveyor belt is no longer the only structure in the room, and the salary arbitrage of switching companies is no longer the main financial lever available to young workers. When the salary gap closes, you have to ask, okay, if it's not salary growth through job hopping, and it's not salary growth through staying loyal and waiting for promotions, what actually works? And this is where you get to the more interesting answer. The answer Gen Z seems to be discovering in real time at scale. But before I get there, I want to sit with something uncomfortable for a minute because there's a version of this story where you hear job hopping doesn't work anymore, and you conclude that Gen Z's stuck, that they're out of moves, and that reading misses everything. Think about what it means that 58% of Gen Z workers describe their current job as a situationship. That's the actual word from a survey of over 1,000 professionals. A short-term arrangement with no long-term commitment, a job they never intended to stay in. Nearly half of them expected to leave within a year. A third are ready to quit at any moment. Now, you might think that sounds chaotic. That sounds like people drifting. But I'd ask you to look at the incentive structure one more time. Companies post ghost jobs. According to several hiring platform surveys from 2024 and 2025, somewhere between 18 and 22% of all online job postings are fake. They're either positions that don't exist, positions that are already filled internally, or positions that are permanently open for resume harvesting. One study found that nearly 1 in 3 employers admitted to posting listings with zero intention of hiring. Another found that 81% of recruiters acknowledge their employer does this. So, the company's relationship with you starts with deception before you've even applied. The job posting itself might not be real. The first conversation you have with them might be a company rehearsing hiring language it doesn't intend to act on. And then after all of that, if you get the job, you're expected to be loyal. That's not a reasonable ask. And Gen Z collectively seems to have internalized this, even if most of them couldn't articulate the structural reason. The trust breakdown isn't a generational attitude problem. It's a rational response to observable behavior. The belt doesn't care about you. So, you start looking for something that moves differently. If this is the kind of thinking you want more of, subscribe. I put out videos that break down how money actually works, not how people want you to think it works. The systems, the incentives, the second-order effects. One click, worth it. Let me give you the mini case study now because I want to make the alternative concrete because everything I've said so far is descriptive. Here's where I want to be prescriptive. Imagine two 23-year-olds, same city, same rent, same background. The first one, let's call her Anya, graduates and gets a job in digital marketing for $65,000 a year. She's good at it. She works hard. She figures she'll be at $75,000 by year 3 if she impresses her manager. In her first year, she puts 5% of her salary into her 401k. She lives on the rest. After taxes and rent and basics, she saves about $400 a month in cash. By end of year 1, she has maybe $5,000 in her 401k and around $5,000 in savings. $10,000 in total assets after a full year of work. The second one, let's call her Priya, gets the same job, same $65,000, but she treats the job as a cash flow vehicle and a skill acquisition engine simultaneously. She learns the skills at work, then she starts applying them outside of work. She starts running paid ads for small businesses on evenings and weekends, 3 clients, each paying her $750 a month for basic ad management. That's $2,250 per month in side income, after taxes around $1,600. By end of year 1, Priya has the same $5,000 in her 401k, but she also has somewhere between $15,000 and $18,000 in additional after-tax income from the side work, most of which she's reinvesting or saving. Her total assets after year 1 are somewhere in the range of $20,000 to $23,000. That's roughly double Anya's. But here's the more important difference. Priya's side clients don't cap her salary. She's not waiting for someone to decide she deserves a raise. If she adds 2 more clients, her side income goes to over $3,000 a month. If she builds a small agency and charges more, it scales. The income is not attached to someone else's budget cycle or performance review calendar. And look, this isn't a story about Priya being smarter. It's a story about Priya running a different system. Anya is on the conveyor belt. Priya stepped off, kept the belt running for its base cash flow, and started building something alongside it. This isn't theoretical. According to recent data, over 70% of Gen Z have a side hustle or are actively looking for one. Nearly half of Gen Z workers in the United States have a side gig, the highest rate of any generation. 62% say they view it as a sustainable long-term model, not a temporary bridge. And 55% of Gen Z workers who have a side hustle say they intend to leave traditional employment entirely and make the side hustle their main income source. The average Gen Z side hustle brings in around $958 per month, which sounds modest, but 29% of Gen Z workers manage 3 or more income streams simultaneously. That changes the math entirely. 3 modest income streams at $900 each is $2,700 per month outside of a salary. That's over $32,000 a year in supplemental income pre-tax, on top of a $65,000. You think the problem is loyalty, but actually the problem is that the loyalty contract has nothing to offer that the market can't replace. Okay, comedic cutaway 1. So, a boomer executive is in a podcast interview and he says, the problem with Gen Z is they want everything instantly. They want to skip the line. They don't understand that success takes time. And the interviewer asks, how long did it take you to become VP? He goes, 12 years. Silence. The interviewer goes, and the pension, still have it? He goes, well, yes, but that's cut. Now, I'm in level 3. The side psychology behind why this is accelerating and why the numbers are about to get more extreme. There's something important happening at the psychological level that I don't think most people are measuring correctly. The numbers I've been citing are data points, but the actual driver of the behavioral shift is something more fundamental. It's a recalibration of what security means. For baby boomers and early Gen X, security looked like institutional loyalty. Stay with the company long enough and the institution will protect you. That was a rational belief in an era where institutions actually operated that way. Pensions were real, job security was real. The implicit contract had teeth. For millennials, there was a partial inheritance of that belief followed by a traumatic update in 2008 and 2009. Millions of people who did everything right got laid off anyway during the financial crisis. They weren't underperformers. They weren't disloyal. They were casualties of a balance sheet adjustment. That experience restructured a generation's relationship with institutional trust. Gen Z watched all of this before they even started working. They watched layoffs happen over Slack. They watched return to office mandates get issued after companies spent 2 years telling employees that remote work was permanent. They watched tech companies hire aggressively during the pandemic and then announced mass layoffs in 2022 and 2023 and continuing through 2025. In 2025 alone, announced job cuts across major employers reached over 1 million between January and October. And then after watching all of that, they were told, the problem is your attitude. I want to be precise about what I'm saying here. I'm not saying companies are evil. I'm saying they are incentive structures, and incentive structures respond to cost pressures, market conditions, and short-term shareholder expectations. That's not a critique, that's a description. The problem is when we ask young workers to behave as though companies are something they demonstrably are not: loyal, reciprocal, protective institutions. When you understand that companies are incentive structures and not loyal partners, you stop asking the question, how do I earn enough loyalty points to be safe? And you start asking, how do I build a position where my financial security doesn't depend on any single structure's decision? That is the psychological shift Gen Z is making, and it's not a soft cultural preference, it's a structural adaptation, and the data shows it. Only 6% of Gen Z say their primary career goal is to reach a leadership position. That number baffles older generations. They interpret it as ambition deficit, but run it through the incentive structure logic and it makes complete sense. Leadership positions in corporate America require you to deeply embed your identity and time into the organization. The ROI on that embedding has declined significantly. The pension that used to compensate you for that embedding is gone. The promise of job security in exchange for loyalty has been broken repeatedly and publicly. So when only 6% of Gen Z wants to be a VP, they're not saying they don't want to succeed. They're saying they don't want to trade the best years of their life for a title at an institution that can restructure them out at the next earnings call. That's not apathy, that's pattern recognition. The belt doesn't care about you, and you've seen it enough times to know. Now, here's where it gets really interesting, because this psychological shift isn't just producing side hustles, it's producing a fundamentally different relationship to risk. Traditional finance wisdom says get a stable job, get employer-sponsored retirement savings, minimize risk when you're young, build slowly. That wisdom was calibrated for a world where the job was stable. In a world where the average Gen Z job tenure is 1.1 years, where 60% of companies have already fired recent graduates, where a third of job postings may be fake, the concept of stable job is already a fiction. The stability isn't there to protect. The risk is already present. The only question is whether you're managing it actively or passively. When you reframe it that way, building a side income stream, investing early, running multiple revenue lines, these don't look like risky behaviors, they look like risk management. You're not taking on more risk, you're distributing existing risk across more systems. That's exactly what an engineer would do. And this matters enormously for the wealth trajectory of this generation because the compounding effect of parallel income streams built early with low overhead is significantly more powerful than the compounding effect of annual salary raises, especially when those raises are capped by budget cycles, manager relationships, and internal pay bands. Let me give you a number that I want you to sit with. If you build a side income of just $900 a month at age 22, and you invest $600 of that per month into an index fund at a historical average return of 8% annually, you don't have to stop working. You're not quitting your job, you're just running a parallel system. After 20 years, that side investment alone compounds to somewhere around $350,000 in invested assets. That's before your primary income, before your 401k, before any equity in a business. Just the investment of a modest side income, started young, held consistently. The person next to you who stayed fully on the conveyor belt, worked hard, got their promotions, and never built a parallel system, they might have a better title, they might have a nicer office, but they also have a single point of failure. One decision by one manager at one company determines their financial trajectory. That's not stability, that's concentrated risk wearing the costume of stability. Level 4, the final layer, what actually works now and why most people will still miss it. Here's the reversal I want to land clearly. You think the problem is that Gen Z is disloyal, but actually the problem is that the institution earned the disloyalty and then complained about receiving it. But there's a second reversal that almost no one talks about, and this one is more important for your actual financial life. Most of the conversation about Gen Z and work focuses on the refusing to stay, refusing to be loyal, refusing to give their best years to a company. And that framing makes it sound like the move is purely reactive, like Gen Z is just pushing back. But the smarter people in this generation aren't just refusing the old system, they're building a new one. And the architecture of that system is what I actually want to spend the last section of this video on. Think about what actually creates wealth in 2026, and I mean real wealth, not a nice salary, not a comfortable career, actual structural compounding wealth. It comes from three things: ownership, leverage, time. Ownership means you hold something that appreciates or generates cash flow without requiring your constant physical input. That could be equity in a business, it could be a content library, it could be real estate, it could be an investment portfolio, but the key is that you own something. Leverage means your output is not linearly tied to your input. If you trade time for money at a fixed rate, you have no leverage. If you build something that generates value while you sleep, you have leverage. A salary is the lowest leverage financial instrument available to a person. You stop working, it stops, full stop. Time means you start early enough for compounding to work in your favor. This is the one variable that cannot be recovered once it's spent. Every year you spend fully on someone else's conveyor belt at a fixed hourly rate is a year where compounding works for someone else, not you. The traditional career path optimizes for one thing: a high stable salary. It does not optimize for ownership, leverage, or time. You don't own anything at your job, unless you have stock options, and most people don't have meaningful ones. Your output is directly tied to your input. You stop working and the income stops. And the promotions you're waiting for consume the early years when compounding would be most powerful. This is not about hating jobs. This is about understanding what the system is designed to produce and deciding whether that output is what you want. Here's the interesting thing. The most financially intelligent behavior in 2026 is also the most emotionally uncomfortable for people raised in the old paradigm because it requires you to tolerate ambiguity, to manage multiple systems simultaneously, and to delay certain kinds of external validation, titles, promotions, the praise of a manager in exchange for building structural position. There's a pattern I've observed and I want to name it clearly. There are broadly two types of people entering the workforce right now. The first type is what I'll call the optimizer. The optimizer takes the job, works hard, pursues promotions, tries to win inside the existing structure. The optimizer is not unintelligent. The optimizer is just playing the game that was handed to them without questioning whether the game is designed in their favor. The second type is what I'll call the architect. The architect also takes the job, but the architect uses the job as infrastructure. The job provides cash flow, skills, network, and benefits. The architect invests surplus cash into assets. The architect builds parallel income streams. The architect treats their income like a portfolio rather than a paycheck. The architect is not anti-work. The architect is engineering a different output. The optimizer and the architect can sit at the same desk, receive the same salary, have the same title, and have completely divergent financial trajectories over a 10-year horizon. The difference is invisible to a manager. It only becomes visible when the architect no longer needs the conveyor belt, and by then the conversation is over. Comedic cutaway 2. LinkedIn post from a VP of culture, and this is a composite, but you know the type. He writes, "I've been thinking a lot about Gen Z and their relationship with work. They want autonomy. They want purpose. They want flexibility. But here's what they don't understand. The best career moments of my life came from sacrificing, from giving everything to this company for 20 years, and the rewards were incredible." 67 comments. Top comment: "What were the rewards?" He replies, "A great network, invaluable experience, and a sense of pride in my work." Second comment: "No pension, though, right?" He replies, "I'm going to focus on the positive here." Post immediately followed by a return to office announcement for his team. Okay, let me bring this back to the beginning. I opened with a question, not why does Gen Z refuse to give their best years to a company? The real question was, why did it take this long for people to notice the contract was already broken? And here's where I land. The contract broke in stages. Pensions disappeared across 40 years, slowly enough that no single generation felt the full rupture. Job security eroded across 2 recessions, normalized enough that mass layoffs became just another quarterly event. The hiring process became so opaque and structurally deceptive with ghost jobs and ghost processes that trust in institutions became irrational to maintain. And the salary arbitrage of job hopping, which was the last compensating mechanism, has started to compress. What we're watching isn't a generational attitude problem, it's the market clearing. When the old incentives stopped working, people started looking for new ones. And the new ones, side income, parallel systems, ownership, leverage, they're not guaranteed, they're harder, and most people doing them don't do them well. But the best ones, the ones who get the architecture right, are quietly building structural wealth while the conversation around them is still about whether they should be more grateful for their job. So, here are the 3 things I'd actually tell you if you're watching this and trying to figure out what to do. First, treat your job as infrastructure, not as an identity. Your job provides cash flow, skills, benefits, and a network. That's it. It does not owe you security, and it does not define you. The moment you stop treating it as a relationship and start treating it as a tool, you stop making emotional financial decisions and start making engineering decisions. Extract value from it, invest in parallel, and keep your options open. Not because you're disloyal, but because the system already told you exactly how it operates. Second, build something you own before you need it. The worst time to build an asset is when you're desperate. The best time is when you have a salary covering your downside. You don't need to quit your job to start a side system. You need about 10 hours a week and the discipline to deploy surplus cash into something with a compounding return. It doesn't need to be a business. It can be an index fund. It can be a small client base. It can be digital assets. The category matters less than the timing. Start early. The belt will keep moving. Make sure something else is moving, too. Third, understand the difference between risk you're taking and risk you're hiding. A single salary with no assets, no parallel income, and no cushion is not a low-risk position. It is a high-risk position that feels comfortable because you can't see the single point of failure. Diversifying your income is not reckless behavior. It's removing a single point of failure from your financial life. The people who stayed on the belt for 40 years with nothing outside of it are finding that out right now. The belt doesn't care about you. That's not cynicism. That's the system working as designed. The only question is whether you're designing yours. If you want more of this, subscribe. I break down how money actually moves, not how you were taught it does.